Hello, everyone. Welcome to this webinar on the annual Insurgent Brand Report, brought to you by Bain and Company and DSG Consumer Partners. My name is Rohit Shanker. I'm a partner at Bain and a member of our consumer products practice in India. Joining me in today's session is Hariharan Premkumar, Managing Director at DSG Consumer Partners. He heads the firm's operations in India and led investments in several flagship consumer product insurgent brands. In addition to Hari and me, this study has been co-authored by Joydeep Bhattacharya and Dhruv Agarwal, both fellow partners at Bain & Company. The first edition of the Insurgent Brand Playbook was in 2023. This, the third edition, focuses on the 75 to 500 crore scaling journey, along with a sector spotlight on BPC, which, as we know, has been a hotbed of insurgent activity. Over to you, Hari, to get us started.
Thanks, Rohit. Hello, everyone. Very excited to present the third edition of our Game Changers report. To jog everyone's memory, the first edition focused on the initial years of insurgent brand building. We learned that that's a game of patience, grind, focus on capital efficiency, and gross margins. The second year, we focused on all the consumer exits that happened. By that, I mean cash exits. And two of the biggest takeaways were that consumer outcomes, exit outcomes are not unicorn outcomes. But despite that, founders were able to create massive value by just being capital efficient. We saw that most of the exits at the upper end were concentrated in the $200 to $300 million enterprise value mark. But even at that range, founders made hundreds of millions of dollars by just being capital efficient. In this year's report, as Rohit mentioned, we're focusing on the tricky middle phase, the 75 to 500 crore journey. It's also a very interesting phase. It's the phase that separates enduring brands from brands that remain startups. It's the phase when compounding really kicks in. And it's also the phase when brands get to profitability. But before we dive into the report's findings, I'll start off with our introduction section. So this slide here talks about how insurgent brands continue outpacing incumbents in terms of growth. You would have seen it in past years' reports as well. They outpace incumbents by a factor of 2 or 3x in our 6 focus categories. The focus categories being F&B, apparel and lifestyle, jewelry, beauty and personal care, home and kitchen, and electronics. InsurgX, quick reminder, we launched the InsurgX last year. It is our shortlist of brands that are growing well with strong fundamentals. This shortlist got an amazing response when we launched because this was the first ever list that captures growth with business fundamentals. The constraints that brands have to fulfill to make it to the InsurgX is that they have to be over 75 crores in revenues. The 3-year revenue CAGR has to be greater than equal to 30%. And the capital efficiency has to be over 1.5x. Quick reminder of capital efficiency. It is measured as the annual revenue of the business divided by the cumulative capital consumed by the business till that point in time. So let's see the brands that made it to this year's InsurgX. So very happy to announce that we had 32 brands that made it to this year's InsurgX. So this is up from last year's number. In all, we studied 161 brands that had filed their financials, of which 92 of them are over the 75 crore mark. 66 of them had a revenue CAGR of over 30%, and 32 of them also fulfill the 1.5x capital efficiency mark. Food and beverage, beauty and personal care continue to dominate the list. We have the likes of Veeba, Farmley, Lahori in food and beverage. Beauty and personal care had Mamaearth, Minimalist, Pilgrim that were part of the list. And in apparel and lifestyle, we had names like Rare Rabbit, Go Colors, Mokobara, etc. The median metrics for the Insurgex brands, the revenue was at $34 million. The median CAGR was 67%, and the capital efficiency was as high as 2.7x. That is close to the 3x gold standard that we see in our portfolio. So I'd encourage everyone to study these brands closely. These are the brands that are growing well with strong fundamentals. Please, have a close tab on their founder interviews, their marketing tactics. These are the brands that that you have to emulate in order to balance growth with fundamentals. And it's very heartening to see the increasing trend. As I said, last year we had 24. This year we have 32. And it's very, very heartening to see the trend increasing right from FY20 onwards. And at our end, it's, we take it as our responsibility to create more awareness about this playbook and help more and more brands crack the Insurgex list. So before we go into the findings of the report, I'd like to introduce the concept of the Insurgex Plus score. What we found in our study was that there are always 1 or 2 years when the best of brands are not able to make it to the Insurgex shortlist. There are years when they focus on consolidation and, before they start pressing the pedal on the accelerator again. So we came up with this concept of Insurgex Plus for the purposes of this report, where we have 46 brands as part of the Insurgex Plus cohort. These are brands that have been part of the Insurgex in one of FY22, 23, or 24. We will be using the journey of these brands to identify patterns in the 75 to 500 crore journey on key success metrics and key areas to focus on. Moving on to the main report. So this year, we're calling it the Scaling Blueprint, the journey of insurgents from 75 to 500 crores. The methodology we adopted in the report was to answer the 3 most important questions for any founder as they approach the 75 to 100 crore mark. The first question is, how fast should I grow, which is the time to scale. The second is, what should be my guardrails in terms of cost metrics, budgets, etc. So that's the input cost metrics. And third is, what is the capital I should be raising to traverse this journey, which is the capital to scale part of the report. So we'll dive into each one of these in the next section. Starting off with the time to scale, the good news is compounding kicks in post the 75 crore mark. It's no longer as slow as it was in the first 8 years. As you can see in the bar chart, the 0 to 75 crore timeline was 8 years. However, the 75 to 300 crore timeline was just 3, and 300 to 500 was just a year. So compounding truly kicks in after the hard work of the first 8 years in getting to 75 crores. You can definitely aspire for faster growth. But nothing takes away from the broader point that it takes long to build a consumer brand. So even after the compounding in later years, etc., it takes 10 plus years to get to 300 crores on an average. And it takes 12 plus years to get past the 500 crore mark. So it's important that founders starting out know that that's the kind of time commitment, planning horizon that they should have when they're starting out launching their own consumer brands. But that said, there are exceptions always. We've listed a few of them in the table below. So Veeba, for instance, got to 500 crores in 9 years. And there are brands like Mamaearth that got there in just 6 years. But overall, it's a faster journey once you hit 75 crores. So you can change gears and target faster growth after the 75 crore mark. So moving on to the cost metrics and the key guardrails to keep in mind with respect to the cost budgeting. We first focused on gross margins. But before I get into it, I just want to describe the chart. We will be referencing it in the other cost heads as well. So the red thick line is the median value for the Insurgex Plus cohort, the 46 companies I spoke about. The blue line is the non-Insurgex cohort. We also have the top decile and bottom decile Insurgex Plus lines, the dotted lines at the top and bottom, to give you a sense of the range. Now on to gross margins, no surprises here. As you can see, the red line is as flat as it gets. So gross margins are constant across stages at 75 crores, at 200 crores, at 300 and 500 crores. So you do die with the gross margins you're born with. But that said, it's important to pay attention to some category nuances here. So we focused on the two categories, beauty and personal care and food and beverages. So beauty and personal care, the gross margin was around the 71-72% mark. So if you're a beauty and personal care founder, you can't be happy with 56% gross margins. You should be striving to be above 70%. And similarly, if you're an F&B founder, you needn't beat yourself up for not having 56% because the median there is in the mid to late 40s. So it's important to have the category benchmarks. We always recommend that our founders benchmark their cost structures to the best-in-class companies in their categories. And the easy place to start is the publicly listed companies. And benchmark yourself against those companies and please get your gross margin right early on in the journey. Don't have to wait till 75 crores, as we've seen in past reports. Please get it right up front. The second big cost head is the marketing cost. And as you can tell, the red line has a downward slope. So the Insurgex Plus cohort successfully brought down the marketing cost with scale, and they brought it down to the 10% levels. In fact, the top 10%, top decile of Insurgex Plus, brought the marketing cost down to like low single digit percentages. As you can see, it was 1% at 75 crores and it stays at 5% even at 500 crores. On the other hand, the non-Insurgex Plus brands, you can see the struggle in the blue line. If anything, it shows an upward deviation, which is something that's absolutely avoidable. So it's important to get to the 10% marketing cost mark as soon as possible. Ideally, get there by the 200 crore mark itself. There are category nuances here as well. In a category like beauty and personal care, where the gross margins are higher, you have some leeway to operate with higher marketing costs. So if you look at median metrics for beauty and personal care, you can see that the marketing cost was in the mid 30s, even at scale. But brands are able to afford it because of the higher gross margins in beauty and personal care. But in all other categories that are operating in 50 to 60% GMs, our recommendation is to bring the marketing cost down to 10% levels, ideally lower by the time you hit 200 to 300 crores. The third big cost head is people costs. And what we discovered was that the people costs stay rather stagnant for the overall cohort. So it was at that 12% range, all the way from 75 crores to 200 to 500 crores. And the best in class, the top decile, had it in the 4 to 5% range across the journey. And the non-Insurgents Plus, the blue line, had a higher cost, about 3-4% higher than the Insurgents Plus cohort. So I think the big takeaway for us is to ensure that this cost discipline, people cost discipline, is set right at the beginning, because it's proving to be quite sticky, as you can see. But there are category nuances even here. If you look at a category like beauty and personal care, which is largely online heavy, brands have been able to bring down the people cost with scale. It was at 11% at the 75 crore mark, but brands were able to bring it down to as low as 7% by 500 crores. The reason for this is we've seen in our, even in our portfolio, that in digital first brands, the operating leverage kicks in better, and you're able to absorb fixed costs a lot better as compared to categories that are very offline heavy. And food and beverage is a great example of that, because you need the feet on street to build out general trade, modern trade, etc. And as you can tell, the people cost for food and beverage remained in that 11 to 12% mark at every point in the journey in the revenue scale up. So net, please get the people cost right at the very beginning. Try and operate at that 10 to 12% mark. And if you are a digital heavy business, you can definitely target a single digit percentage, like 6-7% in beauty and personal care. I expect food brands to have lower people costs going forward as well, as more and more of them get onboarded on quick commerce, and quick commerce becomes a big channel for this category. So those are the big three heads: GMs, marketing costs, and people cost in terms of cost drivers. And this is how the path to profitability looked in the 75 to 500 crore journey. So the Insurgents Plus brands got to EBITDA breakeven by the 300 crore mark and became profitable from there on. And the non-Insurgents Plus is in a very bad place. You can see the losses only increasing with scale. They were at minus 16%, even at 500 crores. And the top decile Insurgents Plus was profitable and very healthy profitability as well, with 15% at 75 crores. And they built on that profitability as they scaled up from there. So our recommendation is that brands get to profitability in the 200 to 300 crore journey. As you can tell, the Insurgents Plus was close to break even at 75 crores. So they were, which means that they were prioritizing growth, and the levers to drive them to profitability were identified even at the 75 crore mark. So our strong recommendation is to try and get to profitability before 300 crores, ideally in the 200 to 300 crore phase itself. So those covered the profitability metrics. The next part of the report is focused on capital efficiency. No discussion in an Insurgent Brand Report is complete without exploring capital efficiency. So we studied the revenue CAGR and capital utilized by the Insurgents Plus in the 75 to 500 crore journey. The y-axis here is the revenue figure, and the x-axis is capital consumed. And you can see a difference between Insurgents Plus and non-Insurgents Plus. Insurgents Plus only needed 230 crores to go from 75 crores, and they only needed 90 crores to go from 75 to 300 crores. On the other hand, non-insurgents needed 600 crores, just not justified to traverse the same journey. And I also want to point out an interesting fact. As you can see, the x-axis here has a negative dimension as well, which means that there were Insurgents Plus brands that did not need any capital raise to traverse this journey. So you have the option to become profitable and grow without raising capital as well. The way I would frame the findings of this particular chart is that please think of 230 crores as the absolute maximum you would need to go from 75 to 500. We've seen a lot of brands achieve it with much lesser capital. And as you can see in the graph, you can do it with zero capital raise as well. We then broke down where this capital was being used in the 75 to 500 crore journey. So this chart depicts the breakdown of capital usage for non-Insurgents Plus and Insurgents Plus. So of the 230 crores that the Insurgents Plus brands needed, about 55% went into loss funding. So that's about a 120 crore investment in loss funding in that journey. Whereas the non-insurgents needed over 540 crores to traverse the journey, a zone completely avoidable. The capex was about 46 crores for Insurgents Plus brands, and for non-insurgents, it was about 66 crores. So quite comparable. The working capital is an important one. So the insurgents needed about 28% of the 230 crores for working capital, which is about the 60 crore number. Now, what this means is if you assume that it's a gross margin of 50%, it means that they've traversed the 75 to 500 crore journey with a working capital of 90 days. That just means they've run a really tight ship while more than quadrupling in that journey. So very, very important to keep the working capital in check. And I think 90 days is a good thumb rule to have. The working capital of non-insurgents plus looks too good. Please ignore that. That's because they all had stretched payables. So summing up the main takeaways from the 75 to 500 crore journey, once you're past 75 crores and have done the hard yards of the first 8 years, the 75 to 500 crore journey is a lot faster. It only takes 4 to 5 years. The capital used in this journey was 230 crores, but we think you can do it with much lesser capital. The gross margins remain constant, so please pay attention to it early on, get it right. Marketing costs and people costs, please bring it to the 10% levels, ideally lower by the time you hit 200 to 300 crores. And please get to profitability by the 300 crore mark. That'll get you to self-sustainability and you can take control of your destiny. So those are the takeaways from the report. And now I will hand it over to Rohit for a deep dive on beauty and personal care.
Beauty and personal care has been a hotbed of insurgent brands, with more than 300 brands incorporated in the last 20 years. And definitely 5 to 10 brands that have made meaningful inroads, and not just in terms of their size and gaining market share, but actually in reshaping the category. The 44 brands in particular on this page are the ones that have raised more than $3 million in funding. And as a collective, their revenue is actually larger, believe it or not, than most incumbent beauty companies in India. These brands are the most represented in the insurgents list that Hari spoke about. They have a median growth of 60% and a median capital efficiency of nearly 1. But for the brands that have crossed the 75 crore mark, they are growing at 30%, which is 3x the BPC market, and they have a capital efficiency of 1.5, demonstrating a profitable growth formula. And like I said, it's not just about the numbers, it's about what's behind the numbers. And that's really two things. A, the fact that these insurgent brands are building new segments. Many of the segments that you see here on the left did not meaningfully exist just a few years ago. And number two, that they are winning in the profit pools of the future in beauty and personal care, and that is premium and online. And insurgents does not mean small. We often think of it that way, but in their home channel, and that in BPC has typically been e-com, insurgents actually lead incumbents and continue to grow faster in many of the categories. And that's visible here. If you take, and this is an extract of the best sellers for a few categories from Amazon, and we've taken the top two insurgent bestsellers and the top two incumbent bestsellers. And you can see that in two out of the three categories on this page, insurgent brands have a comparable size and a materially faster growth. And we do know that in many categories, it's the insurgents, not the incumbents, that are at the leaderboard when it comes to online. Insurgent brands have successfully leveraged and customized what we call the Insurgent Brand Playbook, which really starts with consumer purpose at the core, which is meeting an unmet consumer need. They've typically spiked on meeting unmet needs, and then have a unique deployment model across both mental availability and shoppability on the channel. And underpinning all of that is innovation, not just in product, but also in business model. Let's start with the first one, which is really about unmet needs. And before we do, we must recognize that all audiences are not the same, and that there is a target audience, a set of premium beauty enthusiasts that insurgents have won with. These consumers are a subset of India 1A, 1B. They're around 6 to 8 million in number. They're affluent, beauty-centric, digitally forward, and globally exposed. They spend 10x the average BPC consumer. They have higher awareness and affinity to insurgent brands. As you can see, they are adopters of new formats. And it is this set that for a very long time has had unmet needs ahead of the general population that have been underserved by incumbent brands. And insurgents have won by specifically addressing these unmet needs amongst this consumer cohort. And here are a few examples of such needs: clean beauty as a segment, convenient home remedies, which is a proposition that Mamaearth, and actually Mamaearth was a bit of both in terms of clean beauty, but also convenient home remedies like Upton, onion, etc., which consumers long considered to be very powerful solutions, but were not easily available. There's a new trend around efficacy, the whole space of actives. It's a very new, it's been around 3 or 4 years, becoming very, very material, especially online and in premium channels. And of course, new trends and formats. Sunscreens for the longest time was a small category. It has exploded in the last 3 to 4 years. Serums as a business was minuscule 5 years ago. It's now more than $250 million as a category, all led by this affluent BPC consumer set, and on the back of the agency of these insurgent brands that have actually met these needs. Amongst this set of consumers, insurgent brands actually spike on various parameters, and this is not normalized. This is actually just percentage of respondents and their ratings across various parameters of top incumbent and insurgent brands. And as you can see on trendy, expert, innovative, doctor recommended, effective, that as a cohort, but also if you take the leading insurgent brand, there is quite some distance between the leading insurgent and the leading incumbent. And insurgents have done this, of course, by meeting an unmet need amongst a premium audience, but also through a unique marketing and deployment model that we call a narrow model, which really prioritizes conversion and audience quality over scale. It's not about being subscale. It's about building to scale, but within this narrow audience. And it's about focusing not just on the top of the funnel, but equally at the middle of the funnel and the bottom of the funnel. And 3 key tenets to this model. The first is high investment on the channel. Again, not just about performance, but also display for brand building. Second, the traditional view of media has sort of been that it is just the medium and not the message. But I think more and more we are seeing that you cannot separate those two. And insurgents have viewed media as a source of competitive advantage. And if you look at things like influencer marketing, sampling, social first demand generation, etc., which is of course been spoken a lot about today, insurgents have been building this for almost 5+ years now, and they continue to look at new methods where they can take the lead on a particular media channel or vehicle that's not being used by the incumbent and really win at scale there. And of course, there is an obsession with the consumer and being able to target consumer cohorts, continuously remarket to them, and measure and calibrate accordingly. And if you look at the outcomes on the right, the unaided awareness of these brands, again, insurgents versus incumbents. Remember, incumbents have been at this for 30, 40, 50 years. Insurgent brand awareness is comparable to incumbent brand awareness. And this is spontaneous awareness. And this is not just true at a metro level, as one would assume, but also true for non-metros, where, for example, amongst this audience, 2 insurgent brands lead on mental availability versus the leading incumbent. And like I said, it's a full funnel model, so it's not just about mental availability and spontaneous awareness. Leading insurgents have also demonstrated a stronger conversion efficiency. And if I just orient you to the red boxes at the bottom left, the consideration to awareness and the trial to awareness is higher for the leading insurgent versus the leading incumbent, higher for the second insurgent versus the second incumbent, and so on, showing that this model is not just, and is a new model, in fact, it's not just about getting to awareness, but really getting the flywheel going to drive better conversions. And they've also built comparable consumer advocacy. So once, this is the NPS methodology for consumers of the brand. And while NPS does take time to build, and you can see here that a lot of the top incumbents are higher than the top insurgents, but the gap is not very large. And as a cohort, the set of insurgents that we looked at as a cohort actually had a higher overall NPS than the incumbent cohort. Innovation is at the heart of the insurgent winning formula. And unlike the more traditional approach, where companies do a few innovations, do them slowly, do them at scale, and hope that they work, insurgents have actually taken a VC-like approach. And every insurgent sort of does this a little differently. And I would say this is a bit of an abstraction in terms of exactly how it works. But the idea is that one does 10 to 15 innovations every year, fully knowing that only 1 or 2 of those will succeed. These 15 innovations are put in sort of into a hopper. There is test and learn done with minimal investments of budget to, after a 3 to 6 month period, establish very clearly the winning products to actually then go big behind. And this methodology has led to, if you see a lot of the products that you see down here, these are all large and they're all within, launched in the last 3 to 6 years. So, be it onion, Upton, niacinamide, serum, multiple SKUs in serums, and so on. And if you look at, online data, and this is, Amazon data as of May 2025, done for a couple of beauty categories. Whether you take the top 50 or the top 25 bestsellers, 60% of products are those which have been launched in the last 4 years. So if you actually had a mix, 5 or 6 years ago, and you were thinking, hey, how do I scale this mix? You're playing in the gray part of the market, because 60% is innovation. And in fact, 40% is launched within the last 3 years. Continuing with the winning elements of their business model, one key aspect has been around building winning capabilities in their home channel of e-commerce. Now, most companies would do what's written on this page in some form. But what the insurgents have really, excelled at is to build a repeatable model of doing this in an always-on, granular, consistent, and agile manner, to the extent that it's deeply embedded in their DNA and ways of working. A few examples. Insourcing of performance marketing. This is an important capability that can drive competitive advantage. And by insourcing this function, they've been able to continuously tweak and refine their model and almost generate learnings which are proprietary in nature because they're not shared with an agency or disseminated more broadly as best practices. Second, the daily sport, or in fact, often the hourly sport of continuously reviewing and making optimization to campaigns. Three, the always on monitoring of what's coming back from the consumer, be it through online searches, ratings and reviews, and response to campaigns. And finally, another example around test and learn. And this is one which I found particularly interesting, which is having, versus testing specific hypothesis, having an always on backlog of things to test. So test and learn as a habit versus just for specific hypothesis. So 10 to 15 tests a month around media mix, deployment, and creative, and really to continuously improve and evolve the current playbook. That's been the success formula. But we must recognize that the success formula has taken Insurgent so far, and they've achieved quite a bit in terms of building new categories or subcategories rather within BPC. As a collective, they're larger than many beauty incumbent companies. But and while it's early days in this movie, so far I think it is clear that there are various points in the scaling journey where Insurgents have actually stalled. Few have scaled beyond 300 and even fewer beyond 500. And this is an area we've sort of understood in great detail working with insurgents who are going through and sort of these scaling challenges. And there are a few common themes and that emerge and implications for how insurgents and founders think about their scaling journey. The first is when we think about scaling online, three key points. The first is there is a share plateau for a brand online as categories proliferate. For example, in one of the beauty categories, online share leaders continuously been in the 10 to 15% mark. Which brand that is has actually changed 3 times in 4 years, but it's never gone, no one's gone beyond 15%. And this is just because categories proliferate, consumers want new news, and so on and so forth. Second, needs continue to get fragmented. We saw the chart about how 60% of bestsellers for multiple beauty categories were launched within the last 4 years. And finally, that online category searches are actually shifting to branded. So if I take the market about 5 years ago, it varies by category, but 60-70% of consumers who would search for something on an Amazon, for example, would be searching for a category term, face wash, moisturizer. Today, nearly 70% of searches are on branded in some categories, which means it's important to win off the platform, not just on the platform. So really 3 implications when insurgents think about their online scaling, which is 1, new news and innovation will be important. B, at a brand level, there will be a ceiling in a subcategories to think about portfolio and also the supporting investment model, because as an insurgent, one is already challenged on the P&L, but then how do you think about launching and supporting a wider portfolio than just the hero brand that made the company big? And third, and this is almost becoming a universal truth now, that brand building and not performance marketing will drive long-term brand performance. And this is not just about winning offline, this is about winning online as well. Second vector, moving to adjacent categories online. And here we've seen that categories, the online ecosystem allows for higher brand stretchability. And brands which have been unable to build more than 3, categories or so meaningfully offline, and that's typically the ceiling that we've seen, have been able to build 5 or 6 categories online. Again, it will never be, the categories 3, 4, 5, 6 will never be as large as categories, subcategories 1 and 2, but they do provide a meaningful incrementality opportunity without much additional investment in either marketing or in capability. And therefore, second port of call is how does one go beyond home category and drive another 20 or 30% of incremental revenue without material incremental investments. The third, and this has been the trickiest for Insurgent Brands is really about offline scaling. And I think three key learnings here. I think first is, the online-centric audience approach for first wave of scaling does not work offline. There are few tweaks needed. Two, few hero products actually drive a bulk of the revenue in GT. And this remains true even now after everything that companies have tried to build assortment. For a category, for a brand, there will be 2 or 3 hero products typically. Whereas you have a much wider portfolio online. And third, the replicating incumbent RTM playbooks lead to subscale system economics. When insurgents try and go to market offline, like incumbents do, it just doesn't work given the smaller starting scale, B, the time it takes to build velocity in the outlets, C, the ability to get the right distributors, and so on and so forth. And therefore, what this really causes when one is thinking about scaling offline, that A, there is a distinct playbook from a demand generation and portfolio perspective. So be it, audience reach and repeated scale, hero product, not master brand led approach, and a customized assortment by channel. What lead products in GT are typically very different from the lead products online. So there's a distinct playbook. One must recognize that and start building that out as one thinks about scaling. And second, from a route to market perspective, the real shift is it's not about quantity of reach. It's about quality of reach, starting with a narrow set of outlets, would even be narrow, from a geographical perspective, ensuring that there is velocity and a proven model for that unit or micro market, and then scaling further after that. So quality of reach, not quantity of reach, should be the focus. And that's something we've seen that insurgents need to learn and do differently from the incumbents when they scale offline. Pulling it all together, I think it's fair to say that insurgents have been very successful in BPC. And beyond the numbers, really, I mean, they have reshaped multiple categories, built new segments that didn't exist earlier, particularly at the premium end, and really taught the industry new methods around identifying and serving consumer raw needs, around innovation, and new marketing and channel models. Yes, there have been learnings in the scaling journey. It's non-trivial, but we are in the early days of the story. And as insurgents scale, they need to recognize that they will need to adopt a playbook that is different from what they followed, and also how incumbents have scaled, and really sort of find that sweet spot of evolving their model without losing what made them great in the first place. On behalf of Bain and Company and DSG consumer partners, Hari and I would like to thank you for watching this webinar. We look forward very much to continuing the dialogue. And in the meanwhile, please do reach out to the authors of the report for anything at all. Thank you very much.